Look at this. Look at this Dow shooting up here. It's up 380 points already. Holy cow. It was 41,000 and now it's 41.3. That's since 11, so 2 hours, pretty good. Thank you, sir. I guess this is officially a webinar now. Let's see what happens. All right, so whatever is causing this, we're moving up at the moment. We're supposed to talk about the Fed statement. Well, that's obviously going to happen at 3, but we got to get Warren ready. So let's see, what do we need to do? Plus financial reporting digest. What the frick is this? Notebook LM. I don't remember doing this. I guess you must have done this at last week's webinar. How weird. Okay. Here's Warren. Here's the Fed. FOMC. Calendar. So we should go back and get the big statement. So March, we want the minutes. That's right, better off giving them the minutes. Although I think that might be the last time we talked to him. The beige book. No, we talked about the beige book. What else did we talk to you about? March minutes. Okay. I'm sure you of the Feds. What meeting was that? March 19th meeting. Of the Feds. March 19th meeting. It's May 7th and time for, is that right? There hasn't been one since March? Oh. Yeah, March 19th. It's May 7th. And time for the next statement in about an hour. You will be able to do a comparison and analysis. Right. Absolutely, I'm ready. Wow, he's got a whole big plan. Okay. All right, so what we're going to do is wait for that to be ready and we're all set. So what else did we promise today? We were going to talk about earnings, I think. Oh boy, do I have earnings to talk about with you guys. Oh. I opened up a can of worms today. So Warren is like totally my go-to guy now because they improved the web access on ChatGPT considerably, and they have I'm using the 03 version of Warren, which is much more sophisticated. Not on all. I mostly use the old GPT for Warren, but sometimes I use the newer version. and he's handling it well. And when I say that, I mean that the core implementation of Warren that we've been using for years now, for 2 years, is able to adapt because it's all been on the GPT platform this whole time. So all of his experience, all the knowledge that we put in there is all still relevant and working in the newest version of GPT. So that's very powerful for us because he understands all the nuances that we've been talking about all this time. And oh, it's interesting. All right, I thought that was, I didn't think that was the article we were on, but we are. All right, so anyway, so he's super powerful, and I'll show you in a minute, but let's just go over this. One thing I'm concerned about, and I talked about that this morning, is that the Fed, in the last 2 auctions, they bought $20 billion of 10 years, and then they of 3 years, and then they bought $14 billion worth of 10-year notes. They're not supposed to be doing that. They're supposed to be selling their notes. So quantitative easing is when the Fed creates money. And how does the Fed create money? By writing a check. That's how the Fed creates money. They don't have any money in their bank account. They just write a check. And the crazy logic we use for the Fed is that the Fed writes a check to buy an asset. The asset goes on their book, and that is a cash equivalent. Therefore, they are able to write a check against the asset that's on their book. So the problem comes along when the assets on their books are based on bullshit valuations, like in the last financial crisis in 2008, when all these mortgage-backed securities that the Fed had on their books turned out to be worthless. And so the Fed had a massive shortfall when it went to liquidate things. That was, part of the financial crisis that we had. And the Fed was not in a position to bail people out because they themselves had massive negatives on their books already. Now that was a joke, because back then the Fed was only $1 trillion in debt. Now the Fed is $7.5 trillion in debt. They were $9 trillion in debt recently, and they've been engaging in what they call quantitative tightening. And what is quantitative tightening? It's when the Fed liquidates their assets, right? So don't forget, this is backwards to how a normal human being does things, because a normal person has to have money first, then they can write a check and buy something, and then you can declare the something to be an asset, whatever. But usually you depreciate your asset. The Fed doesn't depreciate their assets, so they say whatever they buy is worth whatever it is forever, until they have to liquidate it. Then they have to declare an actual profit or loss. So as long as they don't liquidate it, they can pretend everything's fine. So a normal person would save money up and then use that money to buy a bond, right? And either way, though, what you're doing is you're taking, see, the money already exists. If you're a normal person, the money exists. You've already taken that money, earned that money, taken that money out of circulation, right? It used to be in your boss's hands, and he paid it to you as a salary. It used to be in some investors' hands, and they gave it to you as an investment, or it used to be an inheritance, and you got it as an inheritance. But it's the same. You didn't create this money. You accumulated the money. It's not the same as creating it. And you accumulate the money, and you exchange it for a bond, and your money goes into circulation, right? But again, you didn't create new money. You just took money that already existed and took it from your hands and put it out in exchange for somebody's bond. So a slight increase in the circulation of money, not drastic. On the other hand, the Fed has nothing. They don't make it, nobody gives them a salary or anything like that. They have an empty checkbook, but they just write $20 billion on a check, and they hand it to somebody. And because that person has a check from the Fed and it's treated as good from any bank, the bank doesn't check the Fed's balance sheet to see if they can afford it. If the Fed gives you a check for $20 billion, that's just like it's just like if they printed a dollar bill and said $20 billion on it. It makes no difference. They just created it and called it what it is, and now the person who's got it can go take it anywhere and get the cash. So that is what when they're doing that, they're creating liquidity. They are doing quantitative easing. They are creating money, and it's like Schrodinger's cat, right? If you open the box and there's money all of a sudden. So they're creating money, they're exchanging it for something. They get the something, and that's their asset now, but the money goes into circulation and increases the amount of dollars in circulation. So when they talk about quantitative tightening, it means the Fed is now taking their assets and exchanging them for cash on the market, and that will then draw money out of circulation. So the Fed has given away their asset, and money has been taken out of circulation because the Fed doesn't put the money in a bank or anything like that. The money just basically disappears. It no longer exists in circulation, and it goes back into the black hole of the Fed. Very weird way to run a monetary system. But that's what's done, that's what's accepted. Anyway, so the Fed had promised to wind down their balance sheet from an astonishing from an astonishing $9 trillion. $9 trillion is China's net debt. So America has a $37 trillion debt. China's probably got like 18 trillion or something like that. It's about half of that. So it's half of China's total debt. It's bigger than the debt of any country in the world, probably, except Japan. So $9 trillion of Fed debt, which isn't even national debt, it's just Fed debt, is bigger than the national debt of almost any country on earth. It's insane. And they promised to wind it down so people wouldn't freak out about the money supply. And to do that, they have engaged in quantitative tightening. And what they do is very simply is that when their bonds expire, the bonds that they own, when they expire, they let them expire and they don't renew them. And that expiration means cash. The bond expires, the government pays the Fed for the bond in the cash. The cash goes out of the government into the Fed and zeroes out. The problem with that is it removes money from circulation, and it strengthens the dollar. The Fed said they were going to do that. The dollar was strengthening, but last month, the last meeting they had in March, actually, they said, "Oh, you know what? We were reducing our debt, our balance sheet by 25 billion a month. 25 billion a month is only 300 billion a year, and they were $7.5 trillion still in debt, and they were reducing it by 25 billion a month. So that would take 4 times 7, which is 28. It'd take about 30 years to get to reduce the balance sheet at the pace they were going. And then at the last meeting, they dropped it down to 5. They said, well, we're going to reduce it 5 billion a month. So 5 billion a month is now 30 years times 5 is 150 years until they're going to reduce their balance sheet. So as long as we don't have any crisis of any kind for 150 years, they will reduce their balance sheet. Obviously, that's insane. So by doing this, though, what they've done is they basically put back what they didn't take out, which is 20 billion a month, which is $240 billion a year. So now they've pushed $240 billion a year back into the money supply. That's back to quantitative easing, which floods money into circulation and reduces the value of the money, right? There's more money. It's just like more of any commodity. There's more money, therefore its value is reduced. And the dollar fell 10% for that and the tariff reasons and everything else. But overall, the dollar just went down and down and down recently, and now it's down 10% from where it was in January. But so that was what the Fed did at the last meeting, was just as good as if they had lowered rates by at least a quarter point, maybe half a point. It was a huge move that injected a huge amount of money into our system. And even with that, we're just staggering along. So there's a little trick the Fed used that they really don't, they can't use it again unless they blatantly say we are now back to quantitative easing. And that would be a bad signal if they do that. But whether they admit it or not, that'll be interesting today, because whether they admit it or not, they just put $34 billion, almost $35 billion into the money supply. If they do that once a month, that's 354, about almost $450 billion of another stimulus. So the stimulus March was 250 billion. This stimulus would be, if they repeat this every month, would be $450 billion. So they have already flipped from tightening to easing. And so what I wanted to point out this morning was, where's my chart? Oh, here's my chart. So I wanted to point out this morning was the problem with all this is, at the same time, all right, so these are the countries that hold dollars, and see the United States, we hold $44 billion. Other countries hold trillions of dollars. We have, this is 44 billion, not an error. We have $44 billion that our government holds. Other countries hold 700 billion. France has as many dollars as we do. Mexico's got way more than we do. Canada's got double what we do. Brazil has, 8 times what we do. The Saudis have 10 times what we do. See, all these trade imbalances that Donald Trump complains about and says we don't get anything for them. You know what you get for them? They're taking your debt. In other words, Saudi Arabia is giving you $400 billion worth of oil in exchange for your $400 billion that are printed up bullshit. They've agreed to accept your bullshit currency in exchange for their real oil, which you then burn. So you maintain no asset value to the oil that you're taking. China sends you dolls, as Trump likes to talk about. So China sends you $30 per child, or whatever his number is, and we give them our crappy dollars. And China very graciously accepts our crappy dollars in exchange for their actual real dolls that were made by people out of materials. So we are getting an asset in exchange for our bullshit currency. Japan too. Japan sends us a Toyota Camry and we give them pieces of paper. That's the trade. It's not a deficit. We gave them dollars. They accepted the dollars. And their acceptance of these fictional dollars is the entire value of our country. If they weren't accepting these dollars, which are debt-driven dollars, then we would be bankrupt. Then we would not have any money. Then we couldn't sell our pieces of paper for stuff, and our deficit would choke us to death. This is what Trump doesn't understand about economics. All right, I have a trade surplus with my boss. My boss pays me $1,000 a week to work for him, right? So I have a $50,000, $52,000 trade surplus with my boss. That's how Trump looks at the world. What really happened? I exchanged my labor, and my boss values my labor, and therefore it was an even exchange. It wasn't a deficit. Just because it looks like he gave me money and I gave him nothing, it's only because the outside observer is saying, well, he just gave you money for no reason. You know it's not for no reason. All of this freaking work. It's not for no reason. You are exchanging what you have for what he has. He has money and he needs your skills, and you utilize your skills on his behalf, and he then turns those skills into more money. He has a better mechanism than you do to turn your skills into money. Right? So in other words, my skill is analyzing the market and forecasting trends and checking out stocks and coming up with trade ideas and things like that. That's my skill. So I trade my skill for money. People subscribe because they would like to have my trade ideas. They use my trade ideas to make money on their portfolios, to make themselves money. That's the utilization of my skill. Okay, that's fine. But then the money I make, right? Then I have a deficit with who? I have a deficit with everybody. I have a deficit with I have a deficit with my dry cleaner. I have a deficit with a dentist. I have a deficit with a doctor. I have a deficit with Whole Foods. I have a deficit with every single other thing except my kids. That's true. That's true. My kids have a surplus. Well, my kids have no. Wait. I'm giving money to my kids, and I get literally nothing. They don't even do anything for me. So yes. That's a deficit with them too. Damn it. Does anyone give me anything? Oh my God. This is why people have dogs. At least the dog loves you. Not that my kids don't love me, but you know, it really is sad when you think about it, right? So all you're doing is like putting money out. But that's it though. What Trump is complaining about is what everybody complains about. I got bills to pay. I've got bills to pay, but I don't do that because I'm not going to go to Walmart and say if you don't start subscribing to PhilStockWorld, I'm not going to shop here anymore. That doesn't make any sense. They don't need to subscribe to PhilStockWorld. It doesn't work that way. You can't demand the people, and we talked about this before, but I mean, it's just very important to understand this in this context of the global money flow that, you know, this is how commerce works. This is how capitalism works. It doesn't make any sense at all to sit there and say that this is wrong or somebody's cheating you because you give them money for the goods that they produce. Somebody gave you the money. And again, in our case, in America's case, nobody gave us the money. We're just freaking borrowing it. We're just creating more and more and more deficits. But still on a person by person basis, because it's not the government. The government's not like buying all these goods and things from China. It's the people. And the people in America choose to purchase goods and services from these places. All these countries, we are purchasing goods and services. American corporations and American people are deciding, I want to get my boots from Spain, and I want to get my handbag from Italy, and I want to get my matzah from Israel, and I want to get my dolls from China, and my iPhone from China, and my it's a lot of crap from China. And I want to get my sushi from Japan. You guys might not, but I actually go to a place that flies the fish in from Japan. So I do get my sushi from Japan. Notice Hong Kong is written separately from China. So China is 3.1 and Hong Kong's 4.3. That's scary, right? Even Thailand. Can you believe we have $200 billion from Thailand? But all these countries are funding our deficit and are currently holding. Why are they holding it? Because I sent the money to China, because I bought 30 Barbies for my kids. I probably did buy 30 Barbies. You know, Trump might be right. I probably did buy 30 Barbies for my kids. I mean, certainly between Barbies and My Ponies or whatever, remember what was it? My Pony? I don't know. Anyway, that was another big toy when they were young. Lots of Barbies, lots of My Ponies, lots of stuffed animals. So I'm pretty sure all that came from China as far as I could tell. Anyway, so China sent me 30 Barbies. I sent China, I don't even know what a Barbie costs, whatever, say $600 for 30 Barbies. They've got my $600. That's where this number comes from. All those people giving them money for the Barbies and the Hot Wheels and whatever else they make over there. Whatever else they make, and for every single thing in your house, basically. That's where the money goes. So here it's Toyotas. Here it's all the crap in your house pretty much is from here or here, from China or South Korea or Hong Kong or Malaysia, Indonesia, some of it Philippines. But that's what it is. It's money we sent. We gave it to them. We gave it to the store, and the store paid them. Blah blah blah. Some percentage went to China. And iPhones, of course. That's a biggie. So that's why they have all this money. But you know what? They have been accumulating it because dollars are considered good things to have. So if they're going to have something in exchange for their stuff, when they get money back, they're happy to keep it in dollars. And our debt grows and grows and grows, and it's pushed out across all these different countries. And it's not about a trade deficit. It's just a natural means of exchange. It's perfectly normal to have certain things that you want from certain countries and certain things that you don't need from certain countries. And the trade deficit is just a number. It doesn't matter. And again, it's like I said, like me going around to my doctor and my lawyer and my accountant and Whole Foods and the gas station and demanding all of them even up their trade deficit with me. It makes no sense. It's not even a teeny bit logical what Trump is saying. And by calling it a problem or a crisis or whatever and arbitrarily putting in rules to fix it, there's nothing to fix. The fixing is breaking. The fixing is breaking the system. And I'm sorry if I say, I know I said a lot of it like last week or the week before, whatever, but the thing is, you gotta understand how catastrophically horrible this is. And you have to understand how this can collapse the entire global economy. This is so radically wrong and so fundamentally misunderstanding the entire concept of the global economy that it is catastrophic. It's like basically saying that it's basically like saying you understand an internal combustion engine, therefore you're going to put ketchup in your car because ketchup is cheaper than oil. And you say, so therefore I've decided that I'm going to put ketchup in the car and we're going to save money. And no, you're not. You're going to brick your engine and you're going to destroy the car and you're going to get nowhere. All right, but that's not going to stop you from doing it if you don't listen to me. If I can't convince you of logic and common sense, and you say, and I tell you, no. See, you understand how internal combustion works, but you don't understand the combustion of the fuel that you're putting in there and what combustion actually means. You might understand how something goes into the engine and it heats up and explodes and it drives the piston, blah, blah, blah. And you can think you understand all that, which you probably don't anyway. But you can think you understand all of those things, because if you did understand it, you could tell me how a Wankel rotary engine works. And if you can do that, then you understand it. But if you can't tell me how a Wankel rotary engine works, then you don't actually understand combustion as much as you think you do, because those things are weird. But I had a Mazda RX-7. It was a freaking great engine. I have no idea how it worked, but it was great. Anyhow, so the point is, none of that allows you to put ketchup in the engine as a fuel. But even no matter how well you understand it, you still have to understand the concept of what is exactly happening when the fuel goes into the engine and is ignited. That's part of the process. You can't understand everything but what the fuel does. And this is the problem, because that's what Trump is doing. He's making a basic misunderstanding of a fundamental part of the international trade and how money flows around the country and capitalism in general. Just completely misses the point. Yet he's going to take the fundamental feature of capitalism and trade, and he's going to basically just completely alter it based on his misconception. And people are telling him exactly the same way I would tell you. Ketchup is, yes, ketchup is a liquid. It has a similar viscosity to gasoline. It will flow to the engine, but it will not ignite for the following chemical reasons. Whatever. It doesn't have a loose electron to whatever. You know, I could make charts, I can get diagrams, I can bring scientists in, but if you're not going to frickin' listen and you're going to do it anyway, it's not an experiment. It's vandalism. And that's what's going on right now. So the non-science people, who are also non-economic people, who run the government now and are in the Senate and in the House and all over the place and in all the departments of the cabinet, all these people who don't listen to facts all think it's going to be a great idea to just shake things up a little. Let's see what happens. We know what's going to happen. You are going to destroy the global economy. That's what's going to happen. And it is absolutely clear that that's what's going to happen. All right. So yeah, and yes, of course, obviously, they are supposedly going to unwind a lot of this stuff and so on and so forth. And could we survive on 10% tariffs? Yeah, you know, we can survive on 10% tariffs. It's not so terrible. It's a minor adjustment. But 30% tariffs, 40% tariffs, 100% tariffs? No. That's the end of the global economy. That throws America right into a recession. Most countries are going to go with us, and global trade will halt. And it's just, you cannot imagine a bigger economic catastrophe than what these guys are trying to do. It was already done in the Depression. When we had a depression, it was a reaction to the Depression. They tried this at that time, and it was also a complete disaster. It made things much worse, but it wasn't. But this is much worse than what they did in the Depression. Much, much worse. You know, it's not that no one's ever tried it before. It's just that 100 years ago, it had been tried enough times that when they did it in the Depression, people said, finally, we'll never do that again. That was a terrible idea. I don't know what we were thinking. It was unanimously decided by basically every country on earth that this was not the way to go. In fact, that's why we build the League of Nations and the UN and so on and so forth, was to make sure the countries never got into a situation where they would react like this to each other and destroy all trade and all all economics. You know, that's why we've had this global cooperation for 100 years, is because we kind of learned our lesson that this was not the way to go. So where was I? Oh, yeah. Anyway, the thing is, all these countries have all these dollars, okay? And they're holding them because they like dollars, because dollars are easy to exchange and dollars are trustable, and because they do a huge amount of business with the United States. All these countries do a huge amount of business with the United States. If the United States stops doing business with these countries, because we're tariffing them, what is the goal of a tariff? To make the goods coming from these countries too expensive for Americans to buy. So if Americans are no longer sending dollars to these countries, and these countries have to trade with each other, then what does China want? China doesn't want $3.1 trillion. China wants a trillion yen. And they want the Australian dollar, and they want the Hong Kong dollars, and they want the Thailand baht, and the rupees from India, and whatever the hell Saudi Arabia has. I don't even know. You know, and obviously euros, and they're going to want 1 trillion euros. They're not going to want $3 trillion. They don't trade with America. What would they do with the dollars? And Saudi Arabia, who accepts what they call petrodollars, in other words, oil worldwide, is exchanged for dollars. That's another reason they have dollars. If Saudi Arabia says, what do we want dollars for? And they send very little oil to us. They send not even 1 million barrels of oil to us from OPEC on a daily basis. So it's 1% of all the oil goes to America. It used to be a lot more, and there was a reason that we had petrodollars, and that's not the case anymore. And if Saudi Arabia says, oh, you know what, from now on, we're going to price oil in euros, no more pricing it in dollars, it'll be priced in euros from now on. then what happens to all these dollars that people are using every day? It's how many daily dollars? It's 100 million barrels of oil, right? Times $60 a barrel is $6 billion a day times 365 days a year. That's, God, yeah, that's $2.2 trillion a year just being traded for oil. And that's not all, because realistically, that's the end consumption of oil. But the reality is what happens? The oil comes from the well and it gets put on. So somebody buys it out of the well, then it goes to the ship. The guy who has it on the ship then does it, then he flips it again. And then it goes to the refineries, and the refineries flip it again, and then it becomes fuel that gets consumed finally. So it's maybe 2.5 times that number, because because in that brief time that it goes from the wells to the end user, it's flipped a couple of times, and all those times require dollars because oil is traded in dollars. If you stop trading it in dollars, what are you going to do with all the dollars? So then, and don't forget that was $2 trillion a year in just one transaction. So suddenly all these countries don't need $2 trillion a year to transact their oil with, in addition to the money they don't trade with. All of a sudden there's going to be a flood of unwanted dollar bills finding their way back into circulation, and the circulation of dollar bills will have dropped substantially. So in other words, they lighten up their load of dollars, dropping trillions of dollars into the pool of currency. So that then dilutes the value of the dollar. Not only that, though, but the transactional speed of the dollar will slow down substantially, because we're no longer trading oil in dollars, and we're no longer trading Barbie dolls in dollars, and we're no longer trading movies in dollars. All these things we used to use dollars for are no longer being used. So now there's trillions and trillions and trillions of additional dollars just laying around. It's like overfilling the pool, and it's spilling out the sides, and nobody wants them. So what happens? They lose value. And our currency can go into a downward spiral, and it can be triggered by exactly what Trump is doing. He can destroy the currency, cripple the country, destroy the value of everything you own that you have worked for your entire life that is priced in dollars. That's what's going on. And it's like the housing crisis, when you thought, I had a house, we bought it for $400,000 in 1998. And in 2008, 10 years later, somebody offered us $950,000 for that house. So not 2008, 2006, something like that. So not, so really only 8 years later. It was before the crisis, obviously. So somebody offered us $950,000 for the house. I said to my wife, being an economist, I said to my wife, honey, we should sell it. And she's like, but and our kids were born 2000 and 2002. So they were young, both it's just, both in elementary school or kindergarten, whatever. And so my wife was like, she's like, I'm not leaving. I was like, let's sell it. I sell the house for $900,000, rent an apartment for a couple of years. And I said, honey, I guarantee you we will be able to come back and buy this house back from this guy for $500,000 in about 2 years. I told her that. It's like, this house is not worth $900,000 now. And I said, that's why I want to take the money. I said, it's not worth $900,000. It's an overvalued asset. And so I should take the money, find an apartment that's affordable, and oh, excuse me, hang on. Find an affordable apartment and hang out there for a couple of years while the market to collapse. But she would have none of it, and it turned out I was exactly right. In fact, frankly, we could have bought it for less than what we paid for it, I think, at the end. But that's what happens. It's like you don't know Well, I know, but you know, the average people don't know how bad something's going to be until it happens. Right up until the minute I was banging the table all during 2006 and 2007. And frankly, I look stupid. I did look stupid. I used to put little Chicken Little pictures up on my posts and things because I would be the one saying the sky is falling, and everybody else would look up in the sky and be like, I don't see it. And I'd be like, I'm sorry, you know, and for a year and a half, I kept going, the sky is falling, the sky is falling. Something bad is about to happen, and nobody believed me. You know, the only good thing was that when it did happen, finally, we were very quick to turn around and react because I was like, look there, see, that's it. That's what I've been telling you is going to happen. But the point is, you're listening now and you're saying, well, you know, that sounds terrible, Phil. That would be awful. But, you know, come on, that's not going to happen. I'm not feeling it. So what? We only lost 10% of the dollar's value so far this year. And Trump says he's talking to China, and Trump says he's buying Canada, and Trump says he's buying Greenland, which we don't have it. See, now we don't even have any kind of a thing with Greenland. They don't have any dollars. No wonder Trump is pissed. They're not holding any dollars. So you know, it all seems like it might work itself out, but it will only work itself out if Donald Trump does the opposite of what he says he's going to do. If he reverses and stops and finds some sanity and unwinds these things, and if he doesn't do that, we are totally screwed. So that's where we are. All right. Anyway, moving on now. Do not have any trucks, but it looks appealing. Don't fall into the trap. It's looked appealing every time we bought it, and it never turns around. I hate that one. All right, so we're waiting for Powell. We got about 20 minutes to talk, so we'll see how that goes. We talked about oil. That was crazy. Trump is still very unpopular. Money is, see what's happening here? Actively managed equity mutual funds. Look at this. The money is flying out, flying out. Where is it going? Into equity ETFs. And see, this is what they call dumb money. If the market starts selling off, that will trigger automatic selling from these funds. Internet index domestic. So things that are indexed and not actively managed are just going to sell off. And then there's some actively managed domestic equity ETFs. Google, look at Google with a big hit. It's actually gotten worse, I think. And I've been warning about that for how long have I been telling you guys that Google's model is in trouble? And finally, Apple has let the cat out of the bag because they're testifying about something in court, and you know, their own monopoly issues in court, and they ended up discussing Google, and they made a statement that was basically saying, you know, our Google searches are going down and blah blah blah, and I guess they're trying to say that you can never say that anybody has a monopoly because it seemed like a monopoly and now it's falling apart. But that's not what Google wanted them to say. Look at that RSI diving. That's actually a good sign. That means there's a lot of buyers holding up already. The RSI went from here to here. That's crazy. So you should have some support here, but it's hard to say because you're talking about a real problem in their model. Anyway, so back to earnings. So I asked Shellbot, which is Copilot. We stopped using Copilot a long time ago because it was pretty useless. And once again, it's been useless. We asked it to do a report on earnings, and it did give us a report on earnings. And it wasn't awful, but there were incorrect facts, and it picks on like some random company, Genius Sports, for no good reasons that I could imagine. It got incorrect numbers. It hallucinated on the 6.1% gain year over year is incorrect. I double checked it. So it's nowhere near as good. It's just not as good of a product. So then I asked Warren to check Shellbot's work, and he said, okay, I'll put a report together. And he goes, I mean, look at the size of this thing. And you think you see this much stuff, and you're like, could it, how could it be a good report if it's so big? But there's no wasted words here. I read the whole thing. If you, by the way, if you see something like this, or you can go to your own, you can go to another AI and ask it to shorten it for you. But I was happy to read the whole thing. And what he basically was saying is that earnings beat. So 76% of the S&P is reported at this point, and the beat rate is 77%, which is about normal. Earnings are 8.6 above consensus so far. We were shooting now before earnings season started. Last earnings season, they were predicting 15% better earnings for this quarter, 15 for this year, 15% better earnings. So what's really happening is they're 8.6%, and the tariffs haven't even kicked in yet. So we're not going to come anywhere near what was predicted last year, which is why when you say, when are we going to get back to the highs, or will stocks get back to the highs? No, they won't. The highs were based on projections that are obviously not happening. So you're not going to get back to the highs. There's no reason to get back to the highs. The highs were hallucination. They never should have happened. Like that house for $900,000, right, for $950,000. It was a hallucination. It was an idiot. If they sure there's an idiot who's willing to pay it, but he was crazy. And so the logic and we were staying for the kids. We weren't staying for the value. So we ended up staying, and it bothered me just basically as an investment. It was a bad idea, but the reality was we were settled, we were happy. It was a house, it had a function, and the function that we had envisioned for it was not to make money. That wasn't why we bought the house. We bought the house for the function. Just like you don't buy a toaster to make money on the toaster. You buy the toaster to make toast. Does it make toast? Yes. Then I'm happy with it. That's a utility function of something. We bought the house to put the kids in with their stuff, and to be in a neighborhood where we liked the school and we were happy with everything and the neighbors and so on and so forth. None of that had changed. There was no reason to sell the house other than the financial gain. The financial gain wasn't a good enough reason for us to change everything else that we wanted about the house. So there's other things in play, and that goes for companies too, though. By the way, when you put things in a portfolio, certain types of trades, there's a reason I like to go to 2027 when we're doing options. It's the lack of hassle. I'm moving in for the long term. I don't want to sit there every month and be forced to change every single contract that we have and blah, 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 just to eke out a small additional gain. When our stuff works, it works spectacularly and we make a fortune. There's no reason to try to move beyond it. It's riskier anyway. It's riskier to do the short-term options. We don't do it. The long-term options make plenty of money. We're very happy with the way it sets up, and it's way less hassle. So 62% of the companies are beating, and this is really important stuff. A weaker showing than the 5-year average. Top line surprises were much smaller. See, beating has to be analyzed further, and this is where it's really great to have an AI on the case like this, because top line surprises were smaller, only 9%, 9/10% above average, and the big gap between EPS and sales surprises underscores that margin improvements and cost cutting rather than demand are driving earnings beats. See, this is phenomenal. This is great analysis. This is going beyond, above and beyond basic analysis. So we think if 12 to 13% holds as a final growth rate, it marks the second straight quarter of double-digit profit growth. And yes, don't forget that in Q4, a lot of retailers and such make most of their money for the year in Q4, not here. So you're not going to see all the money in Q1. Revenue growth is more modest. The blended net profit margin for Q1 is 12.4%, continuing a trend of 12% margins. That's a margin, not the jump in profit. So blah, blah, blah. He's throwing out. Now here, this is fantastic. Like I said, it's a fantastic report. Here we have very good information about each sector. He's looking at sector by sector, and we'll just take this one for example, tech and communications. Innovation drives out performance. The tech sectors stood out with surprisingly strong earnings, AI boom, cloud computing, semiconductor companies with the largest contributions and earnings growth. Stark turnaround from a year ago. Alphabet and Meta's jumps. The sector delivered the largest EPS surprise of any group at 23.8%. And again, this is very important to keep in mind though. More than half of all the earnings growth is coming from the Magnificent Seven in the tech sector. Everything else is not doing that well at all. That's one thing he didn't really catch on to, is that you got one sector doing all the work. 83% of the communications beat forecast revenues, tied with tech. They have margin expansion. Everything you want is here in this sector. But not every company in this sector. Look at Google right now. You still have to take it that way. So he's looking at every single sector and telling you like how they're doing, why they're doing it, and what's happening, and whether it's a good thing to go for in the future. So this is fantastic information for going forward. In summary, the sector story is very much of haves and have-nots. How he does it, yeah, let's pull it out. And a recipe for success: innovation, secular demand drivers, proactive cost management. They delivered big growth and upside surprises, cyclical and interest-sensitive sectors. Has muted or negative growth. The consumer realm was split in two: essential spending versus discretionary indulgences, with the former group providing resilient and the latter showing some cracks. From portfolio standpoint, suggests subtle sector rotation may be underway. Q1's winners were last year's laggards, which is exactly what we did. We took the winners off the table. This is why we're doing so good. We took the winners off the table back in February, and we reduced our portfolio substantially, went to a lot more cash, and we stuck with the losers who were, as he says, the laggards from last year. You know, because we expected them to come back, but they just took longer than we thought. Cross-cutting themes. So here he's talking about the themes of what companies are doing that are winning and how things are looking. And now he's saying, so given all that, he's taking some action too. He's saying, given all that, who's actionable coming up? So Walmart is a high confidence bet, beat and upbeat guidance. So Walmart should have a nice report coming up on May 15th. Home Depot, May 20th. Okay, high confidence bet, contrarian beat. And why? Lennar and Taylor Morrison, they already reported solid demand. Lumber costs are easing. And the street is looking for flat comps, so any pro contractor strength or better than feared DIY can push the EPS above the muted bar and spark a relief rally. See, this is fantastic advice. And we will be looking at these for plays. I don't think HG is that cheap. Maybe it is, though. Maybe I missed something. La-da-da. Oh, yeah, it's pretty cheap. Okay. It's not super duper cheap. It's trading at 22 times earnings, times forward earnings, but that's pretty reasonable. I don't mind that. Nvidia, beat and raise. Easy. See, I'm bothered about Nvidia, but I mean, he's saying that this is still a very, very strong path. Salesforce CRM, a margin-driven beat for CRM, he's predicting. Broadcom, I'm all with him on Broadcom. Beat and intact outlook. So we've got 1, 2, 3, 4, 5 plays. 6. We have 6 plays for earnings to look at. He says, if you're hunting for a miswatch, Target. Ooh, discretionary mix. See, I like Target too. Low recent beat rate. Guidance history is already flashing caution. The setup contrasts sharply with value-oriented Walmart and Costco, and widen the performance gaps. I don't necessarily agree with that. I think Target will get it together, and I think they're cheap enough that they're worth a chance. But maybe I'm wrong, so I have to now examine my premise and figure out if I maybe was wrong about this. They did miss over here. They missed by 20% on earnings, but this earnings they beat by 6%, and they went down anyway. People just cannot be happy with Target. I think this is overdone, though. I mean, look at them; they're trading at 10 times earnings. I mean, that's silly. So my premise on Target is this is probably as low as they're going to get, and it's not. It's hard to disappoint if they're already down this low, and therefore I like them for a long-term recovery. So I don't agree, but I will take another look at it before I start placing any bets. I'll tell you that much. So we got all this information from Warren, and he's got, you know, overall advice and so on and so forth to look at. So that's fantastic. Now it's time for the Fed. And we're going to have to wait 3 minutes. So I guess I will sing during the 3 minutes. Oh, whoa, whoa, whoa. What the frick? For God's sakes. Does anyone know what's happening? Good God. Is whenever now everything that was up is down. Stefan says, I saw a stat yesterday that over 6% of all commercial real estate loans were delinquent. Oh, I saw that too, and I forgot to talk about it. You're right. In April, and that was as bad as the height of the financial crisis. Is that true? Yes, it is true. I saw the same statistic. It's very alarming. Also, CEO and co-founder of Apollo said they put 60% of their money into public IGs, and that it currently takes 5 days to sell an IG corporate bond. That's nuts too. You're right. That's what I'm saying, though. There's a lot of very, very dangerous undercurrents that people are flat out ignoring. And also the fact that the market can zigzag like this is insane. Really insane. I mean, for God's sakes, there's no stability here at all. All right, so let's see what they have to say on CNBC.
It certainly doesn't give them any sort of room to elude that. We're going to be looking for indications about how are they thinking about if we have a slowing labor market but not a rising unemployment rate? What do they do from there? That's a really challenging backdrop for the Fed in an environment that's really quite uncertain.
Jim, we just heard Greg sort of saying when he read Powell's comments in his speech a few weeks ago, he sees him as almost erring on the inflation side of the mandate when push comes to shove. And the market is more or less embracing, I think you could say, for a hawkish hold today. How are you, what are you expecting? And do you think that's correct?
Yeah, look, I would disagree a little bit with Greg on this. I
Morgan
think he'd be
Stanley.
more erring on the side of the unemployment rate. I think the unemployment rate is going to give the Fed more high-level information in terms of what they want to do. I think inflation is staying stubbornly high, so I don't think the Fed is in a position right now to really try to counter that at this current juncture, but they will react to the unemployment rate. Look, there's one piece of good news here. The Fed does not have a dot plot at this meeting. They do not have to go on record and make a forecast. So I think that gives them some breathing room to at least start to think about, how they may backpedal a little bit here. I don't think they're going to move today. It doesn't look like June would be on the table at this point either. And I think the Fed's going to try to make it clear that they're just going to still wait and see how both, as David Kelly pointed out, both tax and tariff policies played out.
Brian, jump in here.
Yeah, hey guys, from out west of the Milken Global Conference. Good to see everybody. Listen, maybe I'll take a different tack, but everybody I'm talking to here the last couple of days, a lot of heavy hitters, the bond market,
All right.
et cetera. They're talking less about
Warren, are you ready? Ryder.
We're talking more about Jay Powell. What does this say about Jay Powell, the human being? Does he react to the seeming political pressure of Trump? Powell, as a person, is also, I think, greatly in focus today.
think that's a great point, and of course, we can't pretend like the Fed's making it.
He's got 3 people on screen, not one of them heard what he said. All right, here we go.
Factors into things that we're about to find out. Let's get to Steve Leishman for the Fed's
There it
decision on
is.
interest rates.
The Federal Reserve keeping interest rates unchanged at 4.25.
I mean, it's so short, right?
But seeing a higher chance of stagflation. They didn't use that word, but here's the language they did use. They said the risk of higher inflation and higher unemployment have risen, both of those together in the same sense. They went on to say a further increase in uncertainty, there's a further increase in uncertainty around the outlook, adding that word further to the prior statement. Also noting that swings in exports.
All right, let's get
have
Warren's
affected
thing.
the data. That's why we got to that big negative GDP number, and they took note of that for the first quarter. But saying economic activity still continued at a solid pace. The unemployment rate is stabilized at a low level.
All right, steady. No mention of slowing Tuesday runoff further, Treasury runoff further.
Of the hard data, they say they are watching risks on both sides of the mandate. The decision was indeed unanimous. Quantitative tightening will continue, and the committee is prepared to adjust monetary policy as appropriate, which is data, which is a.
Oh yeah, okay. We'll do that. All right, so Warren has read the statement. He is saying that the Fed fund rate held steady. QT continues. There's no mention of slowing the Treasury runoff further. Economic activity. Now it's only $5 billion a month now. It's hard to slow it anymore officially. Economic activity still described as expanding at a solid pace, but greater uncertainty is now emphasized. The Fed says risks of higher unemployment and higher inflation have risen, adding the dual mandate risk reference. No dissent in vote. Detailed comparison. Fed funds 4.25 is the same. Economic activity in March continue to expand at a solid pace. Continue to expand at a solid pace. Labor market same. Inflation same. Look, it's very. What they actually change? Uncertainty has increased further. Uncertainty around the economic outlook has increased. Oh, wait, what's this? Oh, you got to read this whole thing. Can I? There we go. All right, so the markets are split for a dovish shift. No change in top line assessment, but adds volatility to the trade inflows. Powell may address the government-driven unemployment drag in a press conference. There's no change in phrasing despite the uptick in recent inflation prints. Uncertainties increase, escalation acknowledged. The Fed now formally recognizes worsening outlook volatility. Risk statement, attentive to the risks on both sides. Attentive to risk and judges the risk of higher unemployment and inflation have risen. For the first time in this cycle, the Fed states dual mandate risk is now two-sided, which is, it's hard for them to do anything if it's two-sided. Quantitative tightening, it's still $5 billion. No further QT easing. Voting members, Waller dissented on slowing QT last time. They all voted in favor this time. And unified support suggests continuing strength among hawks. The statement marks a decisive tonal shift. And by the way, what are the markets doing then? We're steady. The statement marks a decisive tonal shift. The key takeaway is that the Fed is no longer pretending it can confidently walk the tightrope between inflation and supporting labor. Instead, it is acknowledging that both risks have escalated. Inflation is sticky and recessionary pressures are mounting. Not good. No mention of additional QT slowing beyond what was the risk acknowledgement could be laying the groundwork for more flexible policy on June and July meetings. That said, no rate cut signs for now, given the recent 6 to 8% given the recent rally off of headlines, VIX in the 40s, 50s, and GDP nows, the Fed likely wants to avoid fanning further volatility, hence steady hand elevated alertness. Strategic implications. Flattening bias, stagflation risk rise, watch for Fed commentary on liquidity, equity, short-term relief form no surprises, but the longer-term caution is warranted, risk reward skewed by unresolved inflation. Dollar, would you like a visual language changes? Yes. Let's see the language changes. And what I'm going to do is I'm going to give him what I wrote this morning. Okay. Oh, okay, that's cute. So he makes these tables now. They don't come out in WordPress, unfortunately. Economic activity continued. So in the latest one, he's saying, why does that say May 7th? Oh, it is May 7th. Oh, I think it's still April. All right. Labor market remains solid. There's zero changes in language. Look how little has changed. Uncertainty has increased further. Uncertainty rising. Uncertainty has increased. Uncertainty has increased further. That is not a good trend. Balance. Risk of higher has risen. QT ongoing at the prior pace. QT slowed. QT pace. Okay. Escalated at each meeting from rising to increase further. Reinforces the Fed's justification for caution, clearly flagging the unpredictable impact of trade policy. Right, and that's not changing. Dual mandate risk, new explicit language in May. The Fed now acknowledges risks of both higher unemployment and higher inflation. A major shift from previous balanced assessment. Implications suggest they are on alert for stagflationary dynamics and not strictly focused on disinflation anymore. This opens the door for either rate cuts or hikes. So that's fun. Economic activity, trade-driven volatility noted. Language remains solid pace. The May statement adds a note that net exports, of course, swings in the data, subtle but important nod to the China tariff chaos. QT balance sheet. Would you like to follow? Okay. Actually, I'd like you to take this into account from my morning report. Da 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 da. Whoop. No. Why are you doing that? Outlook risk bias balance sheet policy. Okay. Your report flagging the stealth treasury purchases is exact opposite of tightening. The May statement drops the explicitly monthly cap details introduced in March. This is not accidental. It's designed to give the Fed operational flexibility to intervene in the bond market without formal acknowledgement. The Fed is managing optics under immense political pressure. See, that's what I said. What's really going on? China's going full throttle on stimulus rate cuts. The US is doing the same covertly with bond buying while publicly pretending to be restrictive. See, that's the key. Credibility crisis brewing. The Powell's Fed is walking a tightrope, still restrictive on paper, but flooding the market with liquidity behind the scenes. The rally is responsive to the central bank balance sheet actions, not fundamentals. The Fed is formally flags. Yeah, that's what I said also. This echoes the 1970s dynamic, supply shocks, tariffs, Fed indecision. This is a very, very dangerous path we're on. This bounce is a short covering rally, not the start of a durable bull run. If China talks stall or data worsen, volatility returns fast. Don't trust the QT narrative. The Fed is now in a yield control by stealth. Expect flattening curves, artificial compression of 10-year yields. The dollar will struggle, coordinated easing abroad and Fed's interventions. and the dollar softness unless Powell defends their credibility. Commodity stagflation risks and dollar softness boost appeal of gold, metals, and energy, but watch the real yields are still volatile. Corporate credit is still light and worsening for small firms. Margin compression is widespread. The Fed's easing won't reach Main Street. This is crisis management in slow motion. Markets suggest today are headlines, but beneath it all, the Fed is just quietly signals it's cornered. It can't tighten without risking a crash. It can't ease without political blowback. So they're doing stealth easing, playing with the optics while trying to regain control of market liquidity. That's exactly right. We're in stagflation watch position accordingly. Would you like a chart of the Fed's balance sheet versus Treasury purchases for the last 3 months to visualize the shift? Oh, sure. I mean, that's what's cool about Warren. It's like he's like sitting there going, yeah, you know what you'd probably like? That's very nice. Oh, Jesus Christ. Yeah, that's not good. So, oh, I'm sorry. Remember I said it was 7.5? It's still 8.5. It's 8.43. Much, it's $1 trillion more than I thought it was. And so I don't understand how that could be going down though. Oh, I get it, because they're retiring, because it's not because they're retiring debt. So they are still retiring debt, but the drop is only from 846 to 843. So it's $30 billion over this period, which is wait a minute. Gotta move that. There it is. So from April, basically from April 1st until now, which is a little bit more than a month, they're offsetting this, and it's not, but it hasn't really affected the curve of the downturn yet, because a lot of bonds roll over. Far exceeding the $5 billion a month cap the Fed officially declared. This highlights covert pivot and quantitative easing, masked under the narrative of the QT slowdown. These hidden interventions effectively inject liquidity, just as geopolitical ad market professions. Would you like to see how concurrent? No, I'm done. It's enough stuff. Wow. Anyway, so not particularly good. Let's put it that way. This is very dangerous stuff. All right, so we got that done. Oh. And the next meeting for the Fed is going to be June. So basically a month and a week from now is the next one. And then we have a late July meeting, and then that's it for the summer. So a lot of stuff going on. All right, now let's hear what the commentary was from CNBC, see what they concluded.
As they used in other times, guys, this notion of the risk of both higher inflation and higher unemployment have risen. It really underscores that idea of there being risks at both sides of the mandate, and the Fed apparently being no closer to figure out which one needs more careful attention from the Fed yet. Kelly?
Steve, thank you very much. Steve Leisman is at the Fed. Stick around though. Let's get some reaction from our panel. Oh. And I'll kind of go in reverse order from what we just heard. Jim,
not one of these panelists knows what they're talking about. All right, so enough of that. So how's this? Oh my God. Well, apparently the market did not like what the Fed was saying. I mean, I guess, yeah, on the whole, what you're saying is there's not going to be any easing. There's no chance of that. And I don't know what the Fed could have said, though, that would have made them happy. It doesn't make any sense. But it's so stupid, though, because these were the lows of yesterday. So what we're doing is going back to the lows of yesterday. The NASDAQ is below the lows of yesterday. It's down 1%, though. So the NASDAQ's down 1%. The Russell's down 0.25%. The Dow is flat, and the S&P is down 0.5 point. So there's not much of anything here. But there was certainly nothing there that would make you want to sit there and throw money at the market and jump into things. And I'm sorry, but that's where we are. I guess we can talk about, you know, this stuff this stuff shouldn't stop you though from doing sensible investing. And yesterday we took a look at our $700 a month portfolio. And even in the stupid, choppy bullshit market, we went from 39,000. Nothing was touched. Not one thing was touched in this portfolio from this time from here. This is from last month at 77.3%, 39,700. And now 93%, 43,350. So we picked up not quite 20%, I guess 16, 17%. All right. Yeah, 16%. So we picked up 16% in a month. And why? Because we don't have a lot of risk here. These are our open long calls. Okay, we had HPE and Trox, which somebody just said something about Trox. Was it Trox they talked about, or was it Vale? But mostly what we have is very, very sensible stocks. Blackstone Mortgage Trust is a REIT. We have a covered call on the REIT. The stock is at 18. We sold the $18 calls back in September, and we sold them for 205, right? So it's 18. So our net entry is 18 minus 205 is 16. And so our worst case, so we bought the stock, and we can see what the stock was. The stock was $18.50 at the time, right? It's the same day. So the stock was at $18.50, and we sold the $18 calls for $2, so that's net 16. So what happens? If we get assigned, we would have we'd have another 10, so that'd be 20, and 6 would be 34. 60. So 3460 divided by 2 is 1730. So our average cost, if we were assigned, well, I'm sorry, we're not going to get assigned. It's not a put. Silly me. I'm sorry. We sold the calls. I guess we must have bought the puts back or something. Oh no, we didn't do puts because this isn't that kind of portfolio. This is a no margin portfolio. We don't sell short puts really in this portfolio. So what we did is we covered the call. So our net went from 1855 to 1650. So our effective entry is 1650, and we get called away at 18 in January, right? Which was 15 months later. We get called away with a $1.50 profit. So, you know, essentially it's a little bit more than 10% profit. So what are we doing this trade for? One, because it's simple and effective. Not only that though, but these guys pay a nice dividend. And we're collecting those dividends as well while we wait. So we're basically in this position, we're going to pick up like 20-something% on a very, very simple play where we cover and we're netting into the stock for 1650 instead of 1855. Then what? Levi's. Okay, first of all, Levi's American company. They're using American cotton. They don't send it all over to China. They don't send the cotton to China and then have it done in China. It's all pretty much done in America. So they're not involved in the tariff stuff. And Levi's are evergreen. Although they probably get a lot of the they might get a lot of the shirts from China. Who knows? But even in a bad economy, people wear pants, and they might exchange them less often. But Levi has shown a clear ability to survive these things. We're running out of time to use this. but these things still go back to 2020. So, you know, if you want to look at a worst case, what's going to be a worst case in COVID? So how did Levi do in a worst case financial crisis? They had 395 because you know, I mean, you could buy them online, I guess, but really, you know, how many people go out of their way to buy jeans online when everything was shut? So the malls were shut for a year, and they only lost $127 million. Of course, they didn't make 400 million that they should have made, but they only lost 127. That's a survivable company. So they go 400 minus 127, recover right away to 500. They have a good year here. They don't have a good year here. They don't have a good year here. And they're catching back up towards 500. So whatever reason they had a cycle, who knows what they're probably investing money or doing something. It doesn't matter really. The point is, this is a company that certainly is capable of making this money, and they've been around for 200 years. They know what they're talking about. And their PE is currently 12.6. It's a $6.3 billion company making, you know, last year made 200 million. This year making 500 million. It's just, it is exactly, it's like 12.6. So, and we have no reason to doubt them, and they're not missing their estimates. And they don't have a lot of debt. They've only got 322 million in debt. You know, which is less than a year's earnings, is always a good indicator if debt is under control. So fantastic company, and we're happy to pick them up in this situation. And so much so that we bought 2 sets of them. And what did we buy? We bought a $7 spread for net $3 basically. And this one was net. This one was even better. Oh, that's why we bought 2 of them, because this one, I don't know, that's not why we bought 2 of them. Oh well, for whatever reason we ended up with 2 of them, but this one's an even better one. This is only $2.30, and this one is just about $3, $2.90. So this is $2.90 and this is $2.30. And that's on a $7 spread, and the spread is currently $3.20 in the money. So we're almost halfway, we're halfway in the money. We've got 20 months to go, right? So we've got about 20 months to go. We're half in the money, on track, and these will both make 100% from from when they started, and we're currently only at 3. So it's still 3 out of 7. So they're still going to make 100% from where they are now. I'm sure I said good for a new trade, given that. Yep. That's great for a new trade. That's exactly what I said. Then you've got our hedge, SQQ. We had a hedge in the portfolio, currently negative. We're losing money on the hedge, but we don't care. That hedge was up almost $2,000 last month. So we reversed by more than $2,000 on this hedge. But that's what a hedge does. It's protecting the rest of the portfolio. Now the longs are gaining, and it's not, the protection is no longer needed, and it depletes itself. It would have been nice to go naked long and risk it at the time, but the last time we did this review, the market looked like it was going to go to doom. So it was very brave of us just to be where we were at the time. VFC is more fashion, and in the lower quarter, right, we're expecting to go up $10, and they're up 25% of that at 250. And here we have a it's not quite $5, it's like a 350 spread, and it's 350. We paid 350 for the $10 spread, and now the net is, well, we're losing, so it's actually worse. So now the net is, well, how do we have such a big loss? Am I crazy? Oh no, it's not. We didn't pay 350. That's right. We paid 450. That's what it is. And now it's 350. We're not even. Now it's like now it's 260. So that's why. So we're down $1,000 on this one, but I like them long term. Northern Dynasty, that what the bet here is, this is a miner that has mineral rights in Alaska, but the mineral rights are potentially deadly to the salmon fishing in the area. And we knew Trump would not care about that. So we expected the EPA to well, there is no more EPA. so I guess they're going to go ahead with their drilling, and the stock went flying higher. It's fantastic for us. So we bought it at 69 cents and now it's $1.07. So that's a nice trade. That's going to work out. And this is the only one we actually sold a put on this. We paid full margin, but we sold the $1 puts for 40 cents. So we collected $400. That means even with no margin in our account, we only had to put $600 down as a margin requirement, right? Because we collected 400, then we have the full margin of 1,000. So we have net $1,000 of a margin requirement to make us $400. So 40% return is fine with us, especially because we're making the money in November of 2025. So we did that in March, and that made it 20 months. So it was a 20-month play to make 40%. That's fine with us. We're very happy making a return like that. Then Foot Locker, and my logic with Foot Locker, which so far is not working out, but my logic with Foot Locker is that Nike's going to have to make a good deal with these guys. Plus, we're selling the short calls for income. And you see how we sold the 1750 calls, and it's now at 12. So those are obviously going to expire worthless. And when they expire worthless, we'll sell more. But we sold $268. And that's how we pick up extra income. So if we do that every quarter for the next year and a half, we're going to have 6 more sales like that. That's $1,200, $1,300, $1,500. So we can pick up $1,500 more dollars, and the whole spread was only $3,000. So we're going to pay for half of the spread with these short calls. So being in the money is going to be a bonus, and I think it'll be good. Macy's actually had pretty good earnings, although it doesn't look like it here. How are they doing? Why are people not liking Macy's? Huh. Oh, no, they didn't have earnings. What am I talking about? Ugh. They had earnings a long time ago. See, 17% beat on the bottom line. But everybody's very worried about them, and they have earnings coming up on March 6th. And again, we sold calls. We sold the 14 calls. They're only at 1157. So these are going to expire worthless, most likely. Oh, and by the way, we have 10 longs, and we only have 5 shorts of 2027s, and we have 2 shorts of January. So I'm sorry. So these are both 2027 puts. We can sell 3 more short-term calls, but we're not doing it. We're waiting for earnings to see what happens. And here's Valet. And here we have we have 2 sets of longs, and we have these shorts, and we're desperately behind at the moment. So it's going to have to go a long way. We're looking for $12. That's a bit of a stretch. Here we have the $8 calls, though, and we're at 931. So in 2 years we could be okay. These calls will be very lucky just to get back to 12. So but it's 23 cents. It's not worth putting more money into at the moment. But anyway, it's very nice that the portfolio came back to 93%. And we still have, given all these positions, when we calculate out how much we can make on them, it turns out to be $37,000 worth of upside, which is 85% between now and January 2027, because we don't have anything that goes past January 2027 yet. So just those trades as they stand now, and we're only using, we're only using $27,000 of our buying power. So we can make $36,000 against $27,000 of buying power. The rest is cash on the sideline. And we are going to be looking to deploy it, but not Not when things are like this. I mean, this is too small of a portfolio to take a lot of risk. We already have risk in the positions we have. So if the market's going to swing back and forth like this, we're going to keep plenty of cash on the sidelines. We are not going to jump to fill up this portfolio because this is freaking insane. People just don't know what they think the market's going to do. They don't know what they want. There's no clear path forward. It's very scary. And here comes Powell. It's even crazier. Bloomberg. Where's Bloomberg? You're not Bloomberg. You're not Bloomberg. Nobody's Bloomberg. Okay. So if we go to Bloomberg when Powell starts talking, there he is.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures.
Oh, that's
inflation has
interesting.
eased significantly from its highs in mid-2022, but remains.
What the hell did you do? So, stance shift, March versus May. Risk balance. So I guess he's saying that really everything is the same, except they really looked at risk as being way up. Overview, the Fed left rates unchanged, both inflation and unemployment. Wait, are we in the right place? Jesus. Despite the March data showing some new detailed comparison, we already did this. China stimulus, U.S. stealth stimulus, market reaction from Powell's press conference. He acknowledges stagflation risk, reiterates the Fed's dual mandate, dodges Trump policy questions, tariffs, deregulation. Financial markets are still pricing in 3 cuts by the end of the year, despite Powell's caution. Well, that's a big thing to watch. Stagflation becomes a policy constraint. The Fed's acknowledgement of dual risks is rare and telling. It signals deep discomfort navigating the tightening market, largely tariff-driven. Powell's balancing act. His language aims to stall the expectations of June cuts despite dovish market pricing. He's trying to preserve optionality. The contradiction between stated QT and net purchases. This may prop up the markets temporarily, but adds to longer-term inflation credibility risk. That is exactly what I think. Markets versus the Fed. The market still, see, I don't, that's a problem. See, this is a very big problem because this is not happening. We are not going to get 3 rate cuts this year. That's just not going to happen. We're running out of time. Half the year is gone. The Fed is clearly not signaling rate cuts soon unless recession has become more pronounced. China's cuts emphasize flexibility and the Fed lacks. Like I said, I think that Z had them cut rates specifically to annoy Trump. It was the timing of being on the Fed day and knowing that the Fed wasn't going to cut rates, and it showed that Z controls his central bank and Trump does not. And that is a big psychological statement when they're negotiating with each other. So right ahead on the day after the Trump says, oh, we're going to be negotiating with China, and right before that meeting and right on the day of the Fed meeting, China does a big rate cut. That's not a coincidence at all. That's Z making a statement that he controls his economy, quote, better than Trump does. And it's the kind of thing that's definitely going to get under Trump's skin and can cause friction between Trump and Powell. So it's all a power move by Z. Oh, he even says that. Z's control of the stimulus tools adds pressure on Powell, especially U.S. bond auction showing weak demand. So strategic implications for investors, equities, fragile rebound, watch for rapid swings on trade headlines, bonds, 10-year drop, likely reflects recession bets, not confidence, US dollar, stimulus optics, raising deficit fears, weakening dollar bias, Fed policy path, no action until late Q3. How are you going to get 3 cuts in if we're not going to move until late Q3? And gold stagflation, Fed analysis, very good for gold and commodities. The Fed is navigating a minefield, tariff-driven war. The next catalyst is going to be the CPI report, the China talks. Oh, he's right on top of stuff, isn't he? The China talks in Switzerland and the tariff expansion updates. Good job. Such a freaking pleasure, I got to tell you. Once you get these guys written right, everything falls into place. He knows exactly what kind of stuff I'm looking for. All right, good. Very nice.
Somewhat elevated relative to our 2%.
Wow, CDW 6.7%.
Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices.
GE Healthcare up 2.5.
Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures.
Apple's down 2%.
Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next
Google
year
is down 8%.
Measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate.
Whoa. Marvell Technology is down 10%. That's painful. I didn't hear about that one. CrowdStrike's down 5%. This is some nasty stuff. That's why the Nasdaq's down 0.5 point.
Employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All these policies are still evolving, however, and their effects on the economy remain highly uncertain.
So, Powell's saying, I don't know what the hell Trump is going to do.
As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored.
So he's basically saying that the tariffs will be catastrophic unless everything goes perfectly and they do the exact right amount of tariffs and they phase them in over time and the economy remains robust and you keep the consumers calm. As long as all of that goes well, then we're okay.
Obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans.
Oh, he's telling it's not
We may
his
find
fault.
ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting,
So they're
the committee
waiting.
continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to
Banks are
sustaining
happy.
maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
All the banks
Our
doing
success
very
in
well.
delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right.
Steve Leisman, CNBC. Thank you, Mr. Chair, for taking my question. A lot has happened since the last meeting. There have been tariffs put on, tariffs taken off, and you know, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out.
I don't know which way it's going to go first. Next question.
As energy costs are down, housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices?
Dow's up 250 is a quick measuring point.
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is the big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think.
I'm very bored. Okay. So they don't know what's going on. They're very worried about, things going up. They're worried about things going down. They're worried about labor prices. They're worried about labor costs going up. They're worried about inflation going up. They're worried about unemployment going up, causing less labor. They have no freaking idea what's happening. They don't know what Trump's policies are going to be. Therefore, they can't make any solid forecasts. Stop asking stupid questions and go away. That's the gist of this press conference. That's fine. It is what it is. All right. So like I said, what we have to do is we have to go back to the reports that we can generate based on what we are observing. No, not this post. That was yesterday. But anyway, I'm saying, you know, it was easy enough to pick winners on, this was on April 5th. And so if you had put in 39,000 on April 5th, you would have made 16% since April 5th. That's very simple, right? I mean, these were the stocks that we picked. We make these picks all the time. I mean, if you go back to the last portfolio review, you go back to the last portfolio review or the Money Talk portfolio review or the top trade alerts, we're picking stuff out all the time. So it's not like we have a lack of ways to play the market. And we just go through periods where we're a little bit more careful than others. I mean, look here, April 8th. Let's take, in fact, yeah, let's do that. All right, we'll finish up. I'm not going to bother going back on other stuff. Let's look at this. Here's what we did on April 8th. T-Mobile. I wish these things updated automatically, but they don't. All right, so here's T-Mobile. That was pick number 1. And why T-Mobile? Because you're going to have a phone subscription. Hourly. Let's do hourly from April. Oh, here's April 8th. So as you see, T-Mobile, it went up, then it crashed, and now it's back over here. It's back where it was on April 8th. So not a very exciting trade, but it's fine. It's holding up. Why it's a buy? T-Mobile's focused on domestic services and home internet as a resilient player, tariff-driven economy. Telecommunications are essential, making the company less vulnerable to economic downturns or trade disruptions. And they have great free cash flow, and their 5G network expansion is just kicking in. Here's our trade. And notice again, we're doing an income thing. We sold the September 26 calls, and as we noted, the 260 calls. So we sold these calls. We weren't expecting it to go any higher. We sold the 260 calls. So we're happy. Flat is our plan because we bought the 200, 250 spread. So we bought a conservative spread that was already in the money, and we sell the 260 calls for income. This is a brilliant strategy. And this strategy is net 15,000 on a $35,000 spread, so it has more than 100% upside plus the income from selling calls. Then we've got General Mills. In fact, let's do it this way. Here's General Mills. It's $58. Why it's a buy? General Mills benefits from its portfolio of food brands, which consumers tend to favor during economic uncertainty. The company's strong margins and cost efficiencies provide resilience against inflationary pressure. But just because we like them doesn't mean we don't sell stuff. We sold the 57.50 puts and calls when they were at 58. So we weren't expecting them to go up at all. All right, and that was what? GIS. GIS. And what have they done since that day? They've gone down. Exactly what we thought. They went down more than we thought, but that's fine. So what are the mechanics of this trade? Look what we did. We sold the $60 puts, and where are they? 55. So they're 55. So we sold the $60 puts, but we sold them for $9. That's net 51. So we're still fine. We bought the $50 calls. We sold the $65 calls. So again, we're still in the money. And we sold the 57.50 short calls for money, and we sold the 57.50 puts for money, and we're going to roll. If it's still at 55, which it probably won't be, but if it's still at 55, we'll roll these along to a longer date. And how about CVS? So CVS, don't forget, this is where we were doing this. This is in the it's on April 8th here. CVS Healthcare offers essential services through its integrated model of pharmacies. The benefits management, the company is further bolstered by the Medicare payment. And again, we sold the 70 puts and calls. So that's our target for July. And it's 66.75. It's actually a little bit higher. I'm sorry, we came in April 8th. All right, so for April 8th is around here. So it's basically right about where we came in. So what was the date of this? April 8th. Yes, it was exactly a month ago that we did this. Elevance, what was our plan with Elevance? The same Medicare increases as CVS provide essential health insurance services. So they had just approved a 5% bump in Medicare payment increases. That goes to their bottom line. As long, I mean, unless they can't control their costs, but if their costs are the same and they're getting 5% more reimbursements from Medicare, that's profit. All right, and what did we do here? We did not sell short-term puts and calls. We just went for the gains on the 400-500 spread. And flat to where we came in. Oh no, well, I mean, depends on what part of the day we came in, but so we came in somewhere around here and it's been pretty much flat. And what do we have? The 400-500 spread. We sold the 330 puts. Union Pacific. They should benefit from reshoring because companies are moving production back to the US. That should mean more domestic freight transportation, and the operators' fuel efficiency initiatives are also helpful. Here we sold the August 220, 240 puts and calls. All right, so UNP. When we sell puts and calls, we're more looking to thread the needle than anything else. That's the most important thing at that point. So 240, 250, it's well below. Where the hell was this on the 8th? So it's flat. That's weird. So it's flat at 214, and we sold the 220 puts. Oh, it'll get there. Okay, yeah, that makes sense. So we sold the 220 puts out. We expected it to go a bit higher, but not that high, and that's what we're playing it for. So we're in great shape on that, actually. Here's Acuity Brands, not one you usually think about. And what we said about this is they specialize in lighting and building controls, benefit from Mexico's tariffs. That gives them a competitive edge over Asian competitors. It focuses on smart building retrofits. And again, what's hot right now? That's what Warren was talking about before. People are spending money on infrastructure and on efficiency. And so if you can provide efficiencies and save people money, that's the kind of thing people are buying. We were looking again, and again, here's our play, but what we care about is we said July 230, 250 puts and calls. And they were at 230, so we expected them to be flat to up. Oh, so it's already at 250. So remember we have the 230, 250s. So it's at the top part of our range now. And that range goes on until July. So I think we'll be okay. We sold those calls for 14 bucks. Look how much money we collected on that. So you see, we spent 50,000, then we got a credit of 15, a credit of 20, so that's 35. So we have net 15,000, and we sold $9,900 worth of puts and calls. That's freaking amazing. This is a great spread. Holy crap. You could do this one spread and have a great year with a portfolio. I mean, that's an amazing 1,076 potential upside. Then we have Steel Dynamics. And we said they're a big beneficiary of steel tariffs, so it should be good for them what Trump is doing. And in this case, and again, we sell the August 110, 120s. That's what we pick for a range. Ooh, a bit over what we picked. But you see how that works? Because we, our main spread. So it's a net $3,750 credit. We have $153,000 of upside potential, 4,000% if they get back over 150. Oh, if they get back over 150, oh my God, they're at 130 already. So what's the downside? We sold the August 120 calls for 10.50. So essentially 130.50 is our break even on the calls. And we're at 130. So we're break even on the calls right there. But we also sold the puts for $10,000. So we have another $10 worth of headroom on the short call sale. And the only reason we're losing money on this is because this spread is going in the money. And if this goes in the money, we make $153,000. So who cares if we lose $10,000 on short calls along the way? But we're not going to lose it. All we're going to do is take the 120s and roll them to September, October, November. So like we're going to roll into like the November 130s or something like that, or the November 140s, or the January 150s. You know, we're just going to widen the spread, move it, sell more puts, and eventually we'll get the right target. But along the way, that's in addition to this money, in addition to this upside potential. We can make money selling short puts and calls. Oh, in fact, say that we should get three more chances to make $20,000 for another $60,000. Here's Newmont, a gold company. They should be doing well. How did we play it? Newmont is good for surging gold prices, and we called August 47.50 is what we were looking for. Ooh, 54. Ho, ho, ho. So again, we got burned. 54 means that the 47.50 calls we sold for 4, that's net 51.50, right, are too much in the money. But we're just going to roll them and adjust. These guys are going to expire worthless. And this spread has 666 upside potential. So we only spent net $68.50 on a $52,000 spread. We can make $45,650. If we lose a few thousand here, it's not a big deal. But we're not going to lose it. We're going to roll and roll and roll again. And we're going to sell more puts and we're going to make it work out. That's why these trades are so powerful. Unless you really get blown out, you've always got a chance to roll and recover. Dollar General is exactly what we were talking about in the discount retailers, right? It's an ideal play. And this was obvious. Now we have earnings knowledge, so we're seeing what we predicted here. Here we were just guessing what was going to happen in earnings season. Now we already know that Dollar General should be doing good. Dollar General thrives during economic downturns. Consumers trade down to affordable options. It has low-cost items, blah, blah, blah. And we were looking for 9,100 on Dollar General. Ooh, still in the range, 9,100, perfect. So this one's threading the needle. And how much do we make on this one? We spent net $15,600 on a $200,000 spread. It was $50,000 in the money to start. It's got $184,000 of upside potential, only at 120. It's at 90 something, I think, right? 93. So we only have to get to 120 and we can make 184,000. That's insane. On $15,000, it's 1,000%. I didn't put the number there. We have 5 more chances to collect this number. So if we come out in the middle, we're going to make the puts go worthless. So above 90 and below 100, the puts go worthless, the calls go worthless, and then we do it again. So we have 5 more chances. That's what I mean when I say that. We have 5 more chances to collect $13,000, another $65,000 of upside potential while we wait. And if this thing hits where we think it's going to go in the next 2 years, we're going to be at 184. That's sick. This is some sick money that we were talking about back here. Now, CarMax benefits from higher new car prices driven by tariffs as consumers shift towards used car vehicles. That's right. And my friend Marcus owns this guy. He used to own them. So KMX, let's see. Oh, and again, what did we play for? Between 75 and 80 is what we played for. And KMX. Ooh, low. Much lower than we thought. Whoa, so what's going to happen to us now? What did we do? So this is the only one that's below, really below where we expected it to be. So CarMax, we thought we were going to hit some good numbers here, and we're not so far. So, what was the number? 66. So we bought the 70-90 spread, but we only spent, we didn't spend any. We spent no money on this spread. So we have zero in this spread. We sold the $75 puts for 13. That's net 62. All right, and we're at what, 66. So our puts are net 62. So we're not in trouble, but obviously not going well. We have the $70 calls. We should probably roll those to the $60 calls. We sold the 90s. That's okay. We sold the 80 calls. Those are looking to go worthless. And we sold the September puts, but we sold them for $8. That nets us for $68 and $67.80. So we're not far off of here. So we're going to roll these to a lower strike, and there's no emergency because we're close enough. The question is, why did they go down? I don't know, frankly. I wasn't paying attention. Why did they go down? And what are their chances of recovering? That's what we got to figure out. So we could stay with it, pull the plug, or whatever. But 1 out of 10 is not that bad for missing. And that's what we do. So, you know, I mean, it's honestly, how many stocks can you have in a portfolio? Oh, what did I just do? So stupid. So it was top 10 stocks to buy amid Trump's tariff environment. So what we did last month is we picked 10 stocks that we thought would hold up during all this bullshit and into earnings season. And 9 of the 10 are working so far. 1 is not working, and we'll have to fix it. I'll probably do something over the weekend about these. Point being, there's always something to trade. There's always going to be ways to make money, and these things are, you know, a few of these things are stunning amounts of money. You know, because again, we had the high VIX and everything else, but they're going to make money as an income producer, and they're going to make money as stocks over the long term, even in this insane environment. And these were only our predictions before we had a chance to see earnings. Now we're going to be ready to pick 10 more stocks. And like I said, how many stocks are you going to have? We're not going to have 120. You know, if we do 10 a month, we're not going to have 120 stocks. So we don't need this many picks, but it's great to be able to pick 10 different stocks that all do pretty well, or 9 out of 10 do well. And especially when your victory, like, okay, the other one, like, let's say it lost $10,000. That's against things that are going to make $50,000, $100,000. You know, you got to look at your upside potentials. This one makes $22,000, 5,000%, because you're starting out with a $400 credit. CVS makes it's a $1,900. This is another credit, $40,000 spread. This one is, ooh, I didn't even write that one up. Anyway, it's 100 minus 70, so it's $30,000, and it's a $100,000 spread. So this one can make $70,000. Union Pacific makes $80,000, 334%. So, you know, obviously, and this one makes $54,000, and Steel Dynamics makes $153,000. These are sick amounts of money. And these are all the winners. The only loser is the last one. So if we stay on track and we make this money and we manage our loser effectively, we are going to make a shit ton of money on just these 10 stocks. And what you have to do is, when you look at these things, you say, will this diversify? First thing you got to say to yourself, will this diversify my portfolio? Will this make my portfolio stronger? Will it make it more diversified? Will it give me a good return on my money? Is it worth doing? And does it fit in my portfolio? If it goes the wrong way and I get assigned and I end up owning the stock for the long term, am I comfortable with that? And that includes the amount, because you need to adjust the amount according to what you can really afford. But that's how we do it. We're not just using the options to we don't use the options to increase our risk. We use the options to decrease our risk and increase our upside leverage. So if we're right, we do really well. And if we're wrong, we have some offsetting protection. That's the key to this strategy. And like I said, we're going to review these stocks and look at them over the weekend. And then next week, we're going to pick, oh, is next week expiration already? Damn, next week is already expiration. Well, maybe not next week. It depends how busy I am. So we have to at some, oh, and then my daughter comes here. Maddie's going to be here on the 20th. I'll still be working, but I don't want to make any big plans for that week either. Anyway, so, but by that time, we will certainly have it done. So next week, we have portfolio reviews and we have earnings. And by that time, we should certainly be ready to pick 10 more stocks based on what we've learned in the last month. All right, so that's our plan. And feel free to remind me of that plan when we do the webinar next week in case I don't make any progress. But I do expect to be reviewing these guys over the weekend and more thoroughly. All right, take care. Thank you so much for coming, and we will do this again next week. Oops, let's see if anybody had an extra question just in case. Oh, Kyle says Geo is down 10% after earnings. Yeah, well, they haven't gotten they haven't done anything with the money yet. So I think we got to take a close look at them and figure it out. But they've gotten a grant or they've gotten $1 billion contract from the government to build. So the question is, how are they doing it? You know, if they're first, you know, with Geo, they have to first build the prison and spend money, then they get to fill it with prisoners and charge rent. So getting $1 billion contract means they first have to spend some money to build the prisons. So I don't, and again, I haven't seen it, but I'm just saying that those kind of companies tend to, people don't understand like investing as a concept. It's like, you know, building infrastructure. All right. Thank you very much, guys. I enjoyed it, and we'll do it again next week. All right. Take care, everybody. Pal's still talking, but I really can't imagine he's saying anything anybody cares about. See, the market's sort of like shambling around. All right. Have fun, folks. Talk to you later.